Have you seen the recent wave of private equity secondaries companies being purchased around the world by investment firms? In 2021, Franklin Templeton bought US-based private equity secondaries firm Lexington Partners for $1.75 billion. In 2021, PGIM acquired European-based private equity secondaries firm Montana Capital Partners. And right here in my home country of Canada, in 2020, Mackenzie Investments, along with Great West Lifeco, acquired an interest in Northleaf Capital Partners. In this video, we will talk about why investment firms are buying private equity secondaries companies. And we'll end the video with a final thought. So let's answer the question, why are investment firms buying private equity secondaries companies? Let's start by looking at the clients of investment firms. These clients are not your typical investors in private equity. To remind you, some of the typical investors in private equity are pensions, endowments, sovereign wealth funds, foundations, and family offices. Clients of investment firms, usually individuals who are looking to grow and preserve their wealth, have traditionally invested in stocks and bonds. Depending on the risk-return objective of the individual, the proportion of stocks and bonds would vary. A common portfolio would be a 60-40 portfolio, which would have 60% stocks and 40% bonds. As we have mentioned in previous videos, alternative investments such as private equity can add return and diversification benefits to an existing portfolio. Now, a challenge with private equity is the illiquid nature of private equity funds. After all, private equity funds usually are 10 years in length. But private equity secondaries help mitigate the J-curve that is involved in private equity funds. So they have a lot shorter duration. If you need a further explanation on this, please check out our video on private equity secondaries. Because of the shorter duration, private equity secondaries are more attractive to certain investors that don't have a long-term investment horizon that pensions, sovereign wealth funds, or other long-term focused investors have. Now, even if individual investors want to invest in private equity secondaries because of their short duration, there is the issue of accessing these funds, since quite a lot of capital is usually required to invest. Through the acquisition of these private equity secondaries companies, investment firms are trying to open up access to investors that may not have had access to private equity secondaries in the past. So investment firms have been buying private equity secondaries companies in hopes of providing their clients with the opportunity to diversify their existing investments, a more liquid vehicle than a typical private equity fund, and access to private equity investments. Now, here's a final thought. The private equity industry has been changing and will continue to evolve. As we pointed out in our previous video titled LP-led and GP-led private equity secondaries, there are new structures being created. The demand from investors to diversify their existing traditional portfolios into alternative investments will most likely continue. And if there is strong demand to invest in private equity, well, not only may we see more acquisitions of private equity secondaries companies by investment firms, but we'll also probably see more innovation in the industry to give more investors access to private equity investments. In this video, we talked about why investment firms are buying private equity secondaries companies. If you have any other thoughts on why investment firms are buying private equity secondaries companies, please share them in the comments below.